Buffett, 2008 Goldman Sachs investment details. Goldman Sachs avoids Lehman Brothers-style bankruptcy. Hi my friends, welcome to ZC's Finance channel. This is the 12th episode of ZC's 5-minute financial series. Last time, we dug into Soros's hyper-detailed Greek debt trade. Today, we shift to a legend with a radically different philosophy, Warren Buffett, and his 2008 investment in Goldman Sachs that redefined crisis investing. What made this trade a masterclass? It wasn't just the $3.7 billion in capital gains, plus $5 billion in steady dividends. It was how Buffett turned Wall Street's panic into a one-sided, yet win-win deal. With terms so shrewd, they're still taught in every top business school. Let's break down the hidden research, negotiation leverage, and long-term strategy most summaries gloss over. First, the crisis groundwork Buffett laid before the call. By September 2008, Lehman Brothers had collapsed, and Goldman Sachs, long a symbol of Wall Street prestige, was teetering. Its stock had plummeted 42% in 21 days, and interbank lending had frozen. Goldman was burning through $1.2 billion in cash weekly, with rumors it had just 60 days of liquidity left. But Buffett didn't react to headlines. He'd spent 3 months studying Goldman's balance sheet. He noticed 2 key points. 1. Goldman's core earnings from investment banking and asset management, not risky subprime trades, was still $4.5 billion annually. And 2. It had $19 billion in high-quality collateral government bonds, blue-chip stocks it could sell if needed. He later told his team, "This isn't a company collapse, it's a confidence collapse. Goldman's value is still there, it just needs someone to steady the ship." Then came the 48-hour negotiation that changed everything. On September 23, 2008, Goldman's CEO Lloyd Blankfein called Buffett, desperate, but still trying to save face. Buffett, knowing he held all the leverage, didn't rush. He laid out 3 non-negotiable terms, each designed to protect his investment and force Goldman to perform. Term 1. $5 billion in perpetual preferred shares, a hybrid between stocks and bonds that paid a 10% annual dividend, $500 a year. At the time, most struggling banks were offering 5-6% dividends to attract capital. 10% was unheard of. Buffett insisted on perpetual because it meant Goldman couldn't force him to sell. He'd collect dividends forever unless Goldman bought the shares back. Term 2. A $500 call premium if Goldman wanted to repurchase the preferred shares to escape the 10% dividend. It had to pay $5.5 billion total, a 10% markup. This ensured Buffett made a profit, even if Goldman recovered faster than expected. Term 3. Warrants for 43.5 million Goldman common shares at $115 each. 10 below the stock's 125 price that day. These warrants weren't just a bonus, they let Buffett profit if Goldman's stock rebounded, turning a safe bond-like investment into a potential home run. Why did Blankfein agree to such tough terms? Because Buffett's investment was more than cash, it was a trust signal. In 2008, Buffett's name was synonymous with stability. If he backed Goldman, it would calm investors. Buffett knew this and used it to his advantage. He told Blankfein, "You're not just buying my money, you're buying the market's belief that Goldman is too big to fail. That's worth 10%. Within 24 hours of the announcement, Goldman's stock jumped 25%, and other banks started lending to it again. Buffett later joked, "I didn't invest in Goldman, I invested in my own reputation." It turned out to be a pretty good investment. Next, the long-term management that maximized profits. Buffett didn't just buy and hold, he tracked Goldman's performance like a hawk. In 2011, when Goldman's stock hit 160, well above the 115 warrant price, he exercised 20 million warrants, netting $900 MA, 10 profit per share. He held the remaining 23.5 million warrants until 2013, when Goldman's stock reached 175, selling those for $1.3 billion, a 60 profit per share. In 2011, Goldman also decided to repurchase the preferred shares, tired of paying the 10% dividend, cutting Buffett a $5.5 billion check, 500 M more than he'd invested. Over 10 years, Buffett earned $5 billion in dividends, 10% annually. Like clockwork, plus $3.7 billion from warrants and the call premium, total gains of $8.7 billion. The real lesson? Buffett's risk mitigation strategy. He never put more than 3% of Berkshire Hathaway's $160 billion cash reserve into one investment, so even if Goldman failed, Berkshire would survive. He also avoided common shares, which could lose all value, and chose preferred shares, which get paid dividends before common stockholders, even in tough times. He summed it up best: the best investments are the ones where you sleep well at night. The 10% dividend meant I didn't have to worry about short-term stock swings, I just collected my check every quarter. If you love this deep dive into Buffett's crisis chess game, hit like and subscribe. Next episode, episode 13, we're moving to Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund. We'll unpack his 2010 Euro short bet, how he used his principles framework focused on debt cycles and political risk to predict the 2011 Eurozone crisis. Build a 10 billion short position across 6 European currencies, including the euro and Italian lira, and turned a brutal 23% loss in 6 months into a 45% profit by doubling down on data, no emotions, no guesswork. Subscribe now, you won't want to miss how Dalio turned short-term pain into one of his career's biggest wins. Thank you.